Hello my dear students, welcome you on my YouTube channel, and today we'll discuss about the monetary policy. As you know that monetary policies are the tools adopted by the government as well as of the central bank of the country to maintain the money supply in the country. As you know that what is the role of money supply? First of all, we have to understand this meaning. Money supply means the purchasing power of peoples and the funds available in the hands of the people, in the hands of the people. Right. So this is a basic criteria that how to maintain the money supply in the economy. If money has a increasing day by day, or it is increasing in the hand of people, and people are gonna to demand more and more commodities, and the demand will go rise up and supply will get shortened in comparative to the demands, so it will create inflation in the economy. This is the basic causes why we need to maintain the money supply. It should not be very large or it should not be very small. If we will talk that money supply, how much money supply should be maintained in the economy, so there are various types of tools adopted or followed by the RBI as well as of the other financial institution. So in details we'll go with the introduction first, that what is actually the meaning of monetary policy. If we'll talk about the monetary policy, it is a macroeconomic policy tools used by the central bank to influence the money supply in the economy to achieve certain macroeconomic goals. And what are the macroeconomic goals? First of all, if you are not aware about the macroeconomics, where we'll talk about in a large concept, in large or as a whole, okay. So in contrast of the macroeconomics, we have microeconomics. So microeconomics talks about the individual need. It talks about the individual needs as comparatively to the macroeconomics. Macroeconomics talks about a group of individuals, or it talks about the national income, as well as in comparative to the microeconomics, it talks about the individual income. So this is the basic differences. First of all, we have to clear with this word macroeconomics, so we can understand the macroeconomic policy. And macroeconomic policy means that will be applicable or that will be followed for whole of the country, right? So monetary policy helps to shape the country's economical landscapes by influencing key factors such as inflation, economic growth, and employment. Majorly, these three indicators are very essential for the economic growth. First of all, the inflation. Inflation means in a general, it is the continuous rise in the price. Continuous rise in the price. Right? Dear students, this is the basic definition of the inflation, that it is continuous rise in the price level of the country. And then economic growth, how to achieve economic growth and maintaining the level of employment. Okay, so next is that the tool like interest rate adjustment and the monetary supply control or money supply control. The Reserve Bank of India seeks to maintain price stability and ensure that inflation remains at a sustainable levels. And central bank also impact borrowing cost and consumers spending and business investment, managing interest rate, etc. In a nutshell, we can see that here that if we'll talk about the monetary supply and money supply works for the country like that. If I have 100 rupees in my hand and my demand is rupees 80, then I would like to save 20 rupees. If due to the government's policies, the rate of interest reduce it. So what it will impact? It will impact that people will borrow more money from the bank, and it will raise the purchasing capacity of the in the hands of the people, and they will demand more commodities, right? Like that, they will increase, it will increase their purchasing capacity, because the rate of interest is downward. So the investment will increase in the economy. If investment will increase, then supply is in abundances, supply will automatically increase. If the supply will increase in the economy, it will reduce the price level of the goods and services. If the price of the goods and services reduced, it means that the cost of an article what I have bought in earlier time rupees 80, then if its price will go down, that will cost me rupees like 60. So what it means? It means that it is going to save more 20 rupees for me. So I have extra 20 rupees now in my hands. This extra 20 rupees will increase the demand in the economy. It will increase the demand in the economy. By this, the people's money supply or the purchasing power capacity has increased. It has increased the purchasing power capacity. Okay, so this will cause the inflation. How? Because people will demand more and more commodity, and when the demand of the certain commodity will get raised, okay, so it will create that situation where the demand falls short of the supply, and at a point, then suddenly the price of the commodity starts increase. When the price of the commodity start increase, it will create the situation of inflation or the price rise. Is it clear? I think that the basic definition of the money supply has cleared with you, that how it impact inflation in the economy. Now we will move with the next, that is types of monetary policy. There are two types of monetary policies followed in our country. That is the expansionary monetary policy and contractionary monetary policy. If we'll talk about the expansionary monetary policy, it is the policies where the supply of money we need to increase, then it is followed. If we find that we have to short the supply of money in the economy, then we will follow contractionary policies. Expansionary policies is employed when a central bank aims to stimulate economic activity, and then for this purpose central bank lower the interest rate and make borrowing more affordable, encouraging spending and investment, and then by this the increased money supply resulting from lower interest rate is expected to boost consumer demand and business expansion, fostering economic growth, right? Which I have already discussed with you in this slide in details, right? So then second point is our contractionary monetary policy. What it is? It means literally that contractionary monetary policy is when the central banks raise interest rate. Why central bank raise interest rate? Because central bank wants that the borrowing should be expensive, and the level of money in the hands of people should be reduced, and the demand for products should be reduced. That's why the goal is to slow down the economic activity and prevent excessive inflation. This is the major focus of the contractionary monetary policy, as well as of the expansionary monetary policy. Focus on economic growth. It focus on economic growth, or it focus on slow down the economic growth. Slow down economic growth. Next, we will find here that what actually the monetary policy process in India. What are the process? That is, the process started at the period of 2015, when the monetary policy framework agreement was signed between Reserve Bank of India and the Government of India. Earlier there was no such kind of agreement, but in 2015 there was an agreement made by the government on the recommendations of the RBI Deputy Governor Urjit Patel, and he emphasizes on the various objectives of the monetary policies, and he reveals that the primary aim of the monetary policy is to ensure price stability. The main task of the monetary policy is to maintain the price stability and maintaining the inflation rate and considering the objective of economic growth. And next is, under the arrangement of the RBI determines policy interest rates to maintain inflation within 4%, and it might be permissible plus and minus 2%. It means that inflation should be around about 4%, but if we will be able to reduce it, then it should be 2, or either it to the 6. It means that the inflation's target is maintained at 2 to 6%, right? So next point here is the RBI issues biannual report detailing the inflation source point and forecasting its trajectory for the next 6 to 18 months. It means that the RBI meet biannually. It means that 2 times in a year, and discuss the major sources of inflation and forecast its policies for next 6 to 18 months rate of inflation. Then comes the next point, that is the consumer inflation. It is the consumer inflation exceed 6% or fall below 2% for 3 consecutive quarters. The central bank is determined to have missed its inflation targeting objective. What it means? It means that if RBI is unable to maintain the inflation rate above than 2% or below than 6%, then it is said that the RBI has failed, or the central bank has failed to maintain the inflation targeting objective, right? So our basic target to maintain the inflation rate is in between the range of 2 to 6%. This is emphasized by the committee, that is Monetary Policy Committee, MPC. In short form it is called as MPC. So next we will move with the objective of the monetary policy. So there are 4 major objectives. First objective is to accelerate the growth of economy, and if we are able to maintain the economic growth, then for that purpose we need first of all to maintain the price stability, maintain the price or inflation rate in between 2 to 4% or 4 to 6%. It is the maximum or it is the minimum target area. Or we have to generate more and more employment. By generating more and more employment, we are able to increase the demand of goods and services, by which the economic growth can be accelerated. And then next point is to stabilize the exchange rate. It means that our foreign reserve should be increased, forex should be maintained, as well as to maintain our currency rate, right? This is the basic objective of the monetary policy. Now we will move with the Monetary Policy Committee that was formed to evaluate all the part of the monetary policies. So idea to set up the Monetary Policy Committee was motivated by the RBI Deputy Governor, that is Urjit Patel Committee. Section 45 ZB. Section 45ZB of the amended RBI Act 1934 provide for an empowered 6-member monetary policy committee. So if the question will be asked from you that how many members are there in the monetary policy committee, then your right answer should be 6 member. It is a 6-member committee. So major provision of this committee is that this committee will meet at least 4 times in a year. How many times this committee has to meet? It have to meet 4 times in a year, and there are 6 members in this committee, as already told you. And then important point, the member of this committee can hold office for the period of 4 years, and important thing is that they are not eligible to reappoint, right? They are not be able to reappointed. So quorum of the meeting, if this committee meet, so it need that 4 members should be presented, and the RBI governor will have a casting vote in case of a tie. If the decision has to be taken, then the RBI governor will vote in a situation of the tie, right? So next important thing is here that what kinds of tools are adopted by the monetary policy. First of all, this is the statutory liquidity ratio. This is SLR in the short form. You have heard it many times. So what is the SLR? SLR means to maintaining the minimum percentage deposits with the commercial banks in the form of liquid, that is in the form of cash. Bank will not lend all money it receives from the depositor. It has to keep some certain level of liquid or in the cash form with it for the purpose of a daily transaction, and the rate of the statutory liquidity ratio at present is 18%. And cash or you might be asked that what is the highest ever statutory liquidity ratio rate percentage? That was earlier at the rate of 39%, 39.5%. okay. So cash reserve ratio, that is every commercial bank must maintain a specific amount to liquid cash and a percentage of total security designated as a liquid monetary in references to the CRR, right? So what is the CRR? CRR is also the part of the commercial bank maintained in the form of liquid or in the form of cash, and the percentage of this is at present 4.5%. Then comes next, that is repo rate. This is again next tool to maintain the price stability, and government the RBI, sorry, the central bank, our central bank maintain all these percentages. If you like that, these are the percentage what I am here mentioning, that 18%, 4.5%. If government if the central bank find that the money supply is increasing in the economy, then they increase this rate. If like that it is 18%, if it would be increased by central bank from 18 to 25%, then automatically it shorten up the money in the hand of people. So how it will shorten the money supply? So I will clear here. If like that, you will find here SLR rate is 18% at present. So suppose that you will deposit 100 rupees in the bank. So out of 100 rupees, bank have to maintain 18% as cash reserve with them, and they can only lend 82 rupees to the borrower. Okay, but for a specific reason, if they have to maintain the price stability and shorten the price, shorten the money supply in the hands of the people, then they will increase this rate from 18 to 30%. So now what has left in the hands of the people, in the hands of the commercial bank? Out of 100, 30 is reserved. So now it remain only and only 70 rupees. So now price money supply has reduced in the market, with the reduced money supply, so investment is in the economy will be reduced, output will be reduced, so by this the economic activity go slow down. This is actually the process of SLR, why we follow the SLR. Okay, so next we will move with the next points. The next point is repo rate. This is the interest rate at which the commercial bank borrow funds from the RBI. It is not like that a corporate sector only borrow from the commercial banks. Sometimes the situation comes when commercial bank needs funds, so they borrow that funds from the RBI, and RBI charges some certain rate of interest that at present is 6.5%, and this is the repo rate, right? What is repo rate? Repo rate is the rate at which a commercial bank borrow money from the RBI. Then comes the reverse repo rate. In contrast, the Reserve Bank of India borrow money from the commercial bank. It means that the rate decided by the commercial bank to lend money to RBI, this is called the reverse repo rate, right? Then comes next open market operation. This involves the simultaneous buying and selling government securities and treasury bills by the RBI. And then bank rate, last one, it is also called as the discount rate. When a commercial bank borrow money from the central bank, commercial bank borrow money from the central bank, the interest rate associated with the transaction is known as the bank rate, right? So this is the tools adopted by the central bank or RBI to maintain the monetary policy in the country. Is it clear? Also, this slide has cleared everything to you. Now, inflation targeting. What are the targeting area of the inflation and why inflation is targeted by every economy, right? So it is a central banking policy that revolves around the adjusting monetary policies to achieve a specified annual rate of inflation. So the principle of inflation targeting is based on the beliefs that long-term economic growth is achieved by maintaining the price stability, and the price stability is achieved by controlling the inflation, right? And then at the end we can conclude over this topic that monetary policy play a vital role in managing the economy by influencing the availabilities and cost of money and credit. Through various tools and actions, central banks can address economic challenges, stabilize financial system, and promote sustainable economic growth, right? So hope so by this lecture you would be able to understand the basic concept of a money supply. Thanks to watch this video.